Well, good morning and welcome. It is now the fourth quarter. It is October 2nd, 2023. I am Kenny Polcari, your host of the party. And what is it that we need to know today after the end of last quarter and the start of the new quarter? Well, September did not disappoint, right? The markets ended lower as we've been discussing. DC averts a crisis, but now is Kevin McCarthy in hot water. And the PCE miraculously is better than expected. Oil, dollar, and treasury bond yields are all up, and they're up again today. The UAW is still on strike, and what do we have for dinner tonight? We're going to have the shrimp Cardinale, all right? So that's simple to make as well, and soon to be a fan favorite. And so September, like I said, did not disappoint. It did what it always does. It remained volatile, lunging forward on some days, only to take it back the next, only to end the month lower from where it began. But do not despair. While it was the worst month so far, all of the indexes are still higher on the year. At 4 p.m. on Friday, the Dow was down 150 points, or 0.5%. The S&P lower by 12 points, or 0.3. The Nasdaq rose by 18 points, or 0.1%. The Russell gained back 10 points, or 0.5%. And the transports lost 17 points, or just 0.1%. Friday's big economic number was the PCE deflator, which, as I told you, was expected to inch higher, both month over month and year over year. Well, month over month, it did rise by 0.4, up over last month, but a hair below the expectation of up 0.5 this month. While the year over year number came in as expected, up 3.5%, which was higher than last month's 3.4%. Yet they somehow managed to get the core number to be even better than expected, calling it the weakest monthly increase since 2020. Making a usually negative word, weak, into a positive word, right? Remember, that's when they do the core, they take out food and energy, right? So they adjust that number. And then the number is that's the number they want you to focus on because it supports their story. And it is now giving the trader types a reason to reignite the Fed is finished story. Not only are they done raising rates, this must mean that they're preparing to cut. I mean, it's comical. At some point, you just gotta laugh. And then we had the clock ticking on that government shutdown, which appeared as if it was a done deal. That was until House Speaker Kevin McCarthy apparently caved in late Saturday on Chucky's demands, right? Aligning himself with the Democrats to get the deal done, leaving the right wing of the GOP unhappy and now threatening to oust McCarthy by the end of this week. Although you have to believe there has to be a backdoor deal that's going to have the Democrats protecting Kevy in what is sure to be this week's battle on Capitol Hill. JoJo wasted no time in calling the MAGA Republicans the problem, telling us that this isn't so hard to govern. Well, I guess not. I mean, just look at the job he's done, right? Whatever. Understand that while Congress pushed this bill to JoJo's desk on Saturday night at 11:50 p.m., it is just another temporary measure. They managed to just kick the can down the road until mid-November. They managed to make a crisis out of something that should never have been a crisis. And then they all pat themselves on the back saying, oh, look what we did. We averted a crisis. Aren't we so great? Expect this now to be front and center in D.C. But again, it will not price stocks in the long term, so don't go making investment decisions on that piece of news. And Sean Fain remains defiant, calling on more UAW union members to strike GM, Ford, and Stellantis as he pushes for that big increase in benefits and wages. Now, this is now entering its third week with no end in sight. I keep asking myself, who's going to blink? The auto companies are trying desperately to drive a wedge between the union leadership and the union members, but it is still ongoing, and they're clearly behind Sean Fain. But like I said, do not despair. Because for the year, the Dow is still up 1%, but it's still up. The S&Ps are up 12%. The Nasdaq is still up 26%. The Russell up 1.4%, while the transports are ahead by 12%. Now, this will change again this quarter, especially if Treasury yields continue to move higher, which they are expected to do. And that suggests that the Fed may not be done raising rates. The surge in Treasury yields during the month gave investors far and wide more options on what to do with their money without adding to risk. At the end of the month, we saw significant moves up in yields. A 2-year ended the month yielding 5.04%. That's up 5.5% for the month. And this morning, it's up 5 more bips at 5.09%. The 10-year ended the month at 4.58%. That was up 12% for the month. And this morning, it's up another 4 bips at 4.62%. The shorter duration 3 and 6 month bills continue to yield 5.4 and 5.5% respectively. The move up in yields pushed prices down for treasuries. The TLT, which is the 20-year bond treasury ETF, which is a good barometer, lost 9% of its value for the month, leaving it down 11% on the year. All while mortgage rates pushed higher. Current 30-year conventional rates are now 7.5% and likely going higher. And if you have a credit score below 740, you can expect to pay more. HELOC loans, another category that sneaks up on borrowers, are now pushing 9+%, and that's just an average. So there's higher and lower. That's up from 4% in January, representing a 125% rise in those costs. Remember, these rates fluctuate monthly and have done nothing but go up month after month all year. And revolving credit, right, they're usurious, ranging anywhere from 10% to 30% based on your credit history and the lender. Auto loans are beginning to go into default, and we still have the pending commercial real estate debacle that is just simmering on the back burner. I mean, I'm just saying these are all issues that will affect markets and maybe some trading psyche. Oil ended the month at $90.79, up a whopping 14% for the month and 30% for the quarter. This as the Saudis and the Russians continue to squeeze Joey's privates in order to stabilize oil at higher prices. In addition, energy demand is expected to grow in 2024 and beyond. Estimates around the street calling for $125 to $150 oil by mid-2025. And that whole China slowing story, yeah, not so much, right? Don't believe it. China has been buying oil from anyone who will sell it to them. And in addition, they're also buying up coal like it's going out of style, right? Both issues that I have been pointing to all year. This, as the U.S. is expected to see oil production here hit 13 million barrels a day this month, a level not seen since Donnie was in the White House, and as demand is alive and alive and alive. But the higher prices are wreaking havoc on Americans' pocketbooks, never mind what it's doing to transportation costs. That will only push up prices of everything we need on a daily basis. Think food, energy, and utilities. This morning, oil's up another 40 cents at $91.25 a barrel. Rising rates helped push the dollar up 3% for the month and up 6% from the July low to end the quarter in the month at 106.16. This morning, we're seeing strength in the dollar again. It's up 16 cents at 106.32, making a new high for 2023. The prior high was back in March when the dollar kissed 106, leaving 108 now as the next upside target for the dollar. And the strength is pummeling the gold trade. Gold ended down 5.5%, ended the month down 5.5%, and the quarter down 7.5% off of the July high to end the month at $18.65 an ounce. And this morning with the dollar up again, the gold algo traders are taking another $12 out of that this morning, leaving it trading at $18.53. Gold is now down 2% on the year, leaving it struggling to find support here, something that it may not be able to do if rates in the dollar are expected to continue to advance. Why? Again, because higher for longer only raises the opportunity cost of holding gold, which pays you nothing in dividends or interest. It makes you feel good, but don't go looking for anything else, which is not a negative and it's not a reason not to buy it. It's just the fact. On Friday, I suggested that we should find support at $18.50. Well, guess what? Here we are. So now what, right? It's all going to depend on what happens with rates and the dollar and all that. Eco data today is all about manufacturing PMIs. The S&P manufacturing PMI is expected to be 48.9, while the ISM is expected to be 47.9, both in contractionary territory. Wednesday brings us the ADP employment report. We're expected to see 150,000 new jobs created. Then we're going to get the services PMI for both of 50.2 and 53.2, both now in expansionary territory. They've been there, they remain there. But the big number will be Friday's NFP report, and that is expected to also show an increase of 165,000 new jobs. The unemployment rate is expected to tick down to 3.7%, down from 3.8%, and average hourly earnings month over month and year over year of up 0.3 and up 4.3%. This morning, U.S. futures are higher. It's a new month and a new quarter. Dow futures up 85, S&P's up 15, Nasdaq up 80, and the Russell is ahead by 6. The enthusiasm is supposedly a result of the crisis averted. And it's the beginning of a new quarter. Remember that the algos were bracing for a shutdown, so they need to be reprogrammed, reflecting relief. And that is apparently what is happening this morning. Now, remember last week we tested that technical level on the S&P, which is the broad representation of the U.S. economy. And that level was 42.38, which found plenty of supportive buyers. And boom, we bounced off of it and up we went. But I suspect that we're going to test this again before this is over, right? And then we potentially going to test a long-term moving average at 4,200, where I think we'll find real support. In any event, we remain in that seasonally weak time of year, right? The September-October time. So I told you that. So don't stress. Stick to your plan. Keep putting your cash into the cash account of your long-term portfolio, and then we can take a look at it in a couple of weeks, right? After I think that a lot of this volatility will subside. European markets this morning were higher, but they've now turned lower as the quarter begins. Eurozone manufacturing activity continues to decline. The news defining the drop as sharp, and the weakness is dropping at a pace that has not been seen since 1997. Input costs were lower, but so was employment, purchasing activity, and inventories. In Germany, the picture's even darker as output fell at the steepest rate in 3.5 years. So overall, not really positive for Europe. The S&P ended the day on Friday at 42.88, down 12 points, after trading as high as 43.33. Recall that on Friday I said that it looks like they want to take it right back to the intermediate-term trend line at 43.84, which would be a 2% move up. Now, while possible, it's most likely not happening again today, and it didn't happen on Friday, and it's not going to happen today either, right? But we are in the 4,200, 43.85 trading range. And while we may test it early this month, I suspect that once we do that, it will fail, leaving us in that 4,200, 43.85 trading range. Year to date, we have communications in the lead, up 36%, followed by tech, up 31%, consumer discretionary, up 24%, energy industrials, up 3.3%, basic materials, up 1%, leaving financials down 3%, consumer staples down 7%, healthcare down 5%, and utilities getting whacked over the head, down a whopping 16% year to date. Other sectors that are higher, semis up 42% year to date, cybersecurity up 17%, robotics and AI up 21%, disruptive tech up 26%. The value trade is up 6%, while the growth trade is up 17%. Small cap growth is up 1.5%, and mid cap value is ahead by just 1%. This is going to be a big month again. We're going to get the latest CPI and PPI next week on the 11th and the 12th, along with all the usual monthly reports. But these two data points will be key to understanding what the Fed thinks might be at the next Fed meeting on October 31st, November 1st. So it's just 4 weeks away. The speculation all month is going to be about, will they raise or will they continue to pause? So ladies and gentlemen, step up to the window and place your bet. Remember, as a long-term investor, you need to eliminate the noise and stick to your plan, even when it feels uncomfortable. If you're well diversified, you have nothing to worry about. Short-term price dislocations create longer-term benefits and then longer-term opportunities. So it's about eliminating the noise, right? Because we've talked about that. Okay, in any event, what do we have for dinner tonight? So this is the shrimp Cardinale, right? It's really, really delicious. Simple to make, takes as long as it takes you really to boil the pasta, right? For this, you're going to need 2 pounds of large cleaned shrimp, right? Cleaned into vein. You need butter. You need a pound of linguine. You need a 1/4 cup of brandy, a cup of heavy cream. You need marinara sauce, and you need salt and pepper to taste, right? Now, turn your oven on to 350, bake 350, right? You're gonna bring a pot of salted water to a rolling boil while all this is taking place. Now, melt a stick of butter in a large bowl and add the shrimp. Toss the shrimp in the butter, season the shrimp with salt and pepper, lay the shrimp out on a baking dish, and bake it in the oven for 5 to 7 minutes. You just want them to turn pink. You don't want to overcook them. Remove them, and now add them to a large saute pan that's going to be able to handle everything else, the pasta and all that. Now, when you do that, now put the linguine in the boiling water. Let that cook for 8 to 9 minutes. You want it to be al dente. Now go back to the large saute pan that's got the shrimp in it. Add the brandy, turn the heat up, allow the brandy to burn off a bit. Now add the heavy cream, turn the heat down to medium-low, and 3 or 4 cups of tomato sauce, right? Turn the heat to simmer, allow it to come together and to thicken. Stir it, season it, taste it, and season it if necessary. When the pasta is done, strain, always keeping some of the pasta water. Take the pasta, add it directly to the saute pan with the shrimp and the cream sauce, and mix it well, right? If it sucks up all the sauce, you know what to do. Take the tears of the god, which is the pasta water, add a little bit to the saute pan just to re-moisten it. You don't want it to be soupy, but you want it to be moist, right? When you're ready, serve this now in large, warmed bowls, and as usual, you know me, have plenty of fresh grated Parmigiana cheese on the table. Some people will use it, some people will not. That's completely your call. You know me, I love grated Parmigiana cheese on anything, and you can serve this dish with a chilled white wine, right? Summer's almost over, although down here in Florida, we're still drinking rosé if you want, but I know up in the Northeast, maybe not so much, so you might want to drink this with a chilled white wine, and you know my favorite is the Pinot Grigio Santa Margherita. In any event, the day and the week is about to get started. The sun is on its way up. It's supposed to be a nice day here after kind of a rainy, lousy weekend, but the weather is set to now turn absolutely beautiful for the next 6 months. In any event, until tomorrow, take good care.